Welcome to Money on Tap, your personal finance headquarters, where we bring out the professionals, experience, and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. We believe wise investing starts with a plan, specifically your plan. Now, your investments may have merit and relevance to a time and place, but this all really depends on you, your objectives, and your goals. My name is Seth Krussman, and I'm here with Ben Brayshaw and John Ryder, and we're planners and partners with Brayshaw Financial Group. Good morning, guys.
Seth, good morning. We have a lot of good things to talk about this morning, so we're looking forward to the show for sure.
Yes, I am looking forward to this show. Good morning, Seth. How are you doing?
Good. Well, that makes two of us this morning. I love to be the contrarian of the group. So we're glad you're listening.
Sorry you're
to
having
Money
such a
on
terrible
Tap.
day, Seth, out there. I'm sorry about that. Sorry about that.
We're glad to have you listening to Money on Tap. And if you're looking to sit down with an advisor and start making some of the right steps towards your financial goals, we welcome the opportunity to do that with you. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook at /3D Investing. So today we want to talk about a topic, how to evaluate an investment. Now, in today's world, you have a huge amount of choices when it comes to the investments for your future. And it's important for you to have a good understanding of the things that you need to look at when doing business with a company. So in other words, you're going to take a look at some of these components when it comes to your hard-earned money.
Absolutely, Seth. You know, just this past week, I had the opportunity of sitting down with one of our listeners. And our listener, I've actually met with her. This is my second time that I met with her. It was about a 45-minute to an hour drive. But I just had a wonderful time sitting down with her and talking to her about some different ideas to consider. She's looking at selling some property that she has down south. And we just had a wonderful time talking about the benefits of that. But I also talked to her about the importance of taking a look at the whole scenario when it comes to your financial planning, when it comes to her financial planning. And we talked about just some different things, such as liquidity. We're going to talk about that today. Risk versus reward. We're going to talk about the objective of why you would invest money, and also about the time horizon. So there's a lot of different things that we cover. But you know, this is a job that we do as advisors all the time. We have companies calling on us all the time. They want to talk to us about different opportunities out there in the investment world. And it's really our job to do a great job of evaluating those different opportunities to see if they make sense for our clients. And to be honest, we have some people that come through our door that they have some different investments that they're selling that, quite honestly, we are not buying. There's just some things out there that it just doesn't make sense to us. And really, when you're talking to an investment advisor, as a listener out there, there should be some red flags that go off in your head about certain reasons maybe why you wouldn't invest here. In fact, we're going to talk about at the end of our show the 5 buyer bewares when it comes to investing your money. But, screening good investment opportunities is really a huge part of what we do for helping our clients. And it's really our job to help ask the right questions when it comes to potential investments for our clients. We found in our experience that there are a lot of investments that may not be a good fit. And it's really our job to help kind of weed through those and to help screen through those. You know, Ben, you often talk about the SIFT, don't you? The SIFT at the beach. Now, I don't know. I don't feel like I play with the SIFT that much at the beach, but every time Ben mentions it, so you're at the beach and you have the SIFT that sifts down the sand and gets it finer and finer?
Yeah, you never played with a SIFT, Johnny?
We were too busy on sailboats, Ben. We didn't have time for the beach. We were out in the water.
Oh, yeah. We're going to talk about some other things. Sailboats, life of luxury there.
Oh, yes.
Yeah. Well, a fond day in my life would be a number of days sitting at the beach with my family. But yeah, I mean, the SIFT, the idea, the concept of, as kids, we play with these things and we watch, the rocks won't get through. We try to push stuff through and it doesn't quite go. It's like putting the round rock through a square hole, it's like, well, It's too big. And, I think understanding the merit and the value and the potential opportunity that something has, sometimes it doesn't go through the SIFT. It sounds good. It might look good, but it may not be the right fit for you. I mean, we say all the time, Seth, I'm just quoting you here. It's your investments may have merit, relevance to a time and place, but this all depends upon you, your objectives, and your goals.
Now, that sounds really good, Ben. Whatever you just said right there, that was amazing.
It's a level of genius, Seth. It's a level of genius. I know.
I'm in awe of both of you right now. Yeah.
But I mean, there's so much truth, and we believe that wholeheartedly. We don't just say it. It is part of our opener, and so, or Seth's opener. And but if you really don't go through the effort to define your goals, your objectives, and your time horizon, you're going to miss out on doing things correctly.
We've all seen where people invest into a certain product having no idea that their money's locked up for a period of time, and then they need the money, and all of a sudden they're complaining about it. I remember having a woman come into my office who was in her 80s who had invested into this product that was a longer-term investment that she should have ever had at 82. And so she was locked into that investment for 12 years. 12 years at the age of 82. Terrible place to have her money invested. And so that was something we were able to help get corrected from the company that issued it to her, but just not the place that you'd want to have your money invested. There might also be, we'll talk about this later as well, different risk tolerances that people may not have. I mean, they might not have the level of risk that they need in order to get into that investment.
And I think today's conversation is going to bring a little perspective from a broader framework. I think a lot of things is that people sit down with is they might sit down with somebody who just sells insurance or just sells mutual funds or is just a stockbroker, and they only work in one distinction. Where with all the different planners we have at our firm, we work in so many different areas, from top to bottom. It's pretty crazy.
It's so true, Ben. In fact, to a carpenter, a hammer, everything's a nail out there, right? Everything's a nail. But no, you need to have a big array of different investment choices that you can go into. And that's really one of the things that we love about being independent here at Brayshaw Financial Group is the fact that we have a lot of different investments that we can choose from. And it's not only a small little category. So when a nail is needed, you use a nail. When a screw is needed, you use a screw. When there's a saw that's needed to cut that investment out, well, that might be a tool that you use as well. So there's a lot of different tools we can use, and we love the opportunity to do that.
Lots to talk about, but and there's all sorts of factors that we are going to bring into this discussion a little bit later when making wise decisions in regards to your investments and what you own. But before we delve into that, it's a time that we enjoy here called Money in the News. Spain breaks up cybercrime gang after $1.2 billion.
They caught you.
Shh, don't tell anybody. Lisbon.
I don't understand why they think this guy did it when we're walking around with all this money.
So, folks, in Lisbon, Portugal, police have captured a cybercrime gang made up of Ukrainians and Russians that allegedly stole more than €1 billion, approximately 1.24 billion, from financial institutions worldwide over a 5-year spree. So the gang, allegedly mastermind identified as Ukrainian named Dennis K., was arrested in the coastal city of Alicante, 350 kilometers southeast of Madrid, according to the Spanish police and European law enforcement and Europol. Is that right? Europol. So the hackers, whose activities have long been tracked by security researchers, used malware to target more than 100 financial institutions worldwide, sometimes stealing up to 10 million euros in a heist. And almost all of Russia's banks were targeted, and about 50 of them lost money in the electronic robberies.
So I just want to say here that I'm one of the victims, and they need to send me my money back.
Yes, Ben, you get so now you're a little Russian, Ben. So I don't know if you have some ties back to this.
Yeah, no, I know.
should hope
I feel
not.
like they stole from me.
Hey, this sounds like one of these things, Seth. There's going to be like a movie made out of this one. I mean, $1.24 billion. That's not a small drop in the bucket. I don't care who you are. Now, we're going to be talking a little bit later in our next story about some ultra-rich people, but $1.24 billion is a lot of cash.
Like if you were to go run into a bank and rob them or something, they only keep a few $100,000 or something like that. It's not like they have a lot of cash on hand. I mean, that even might be high for all I know, but they don't keep a lot of cash. So to rob from banks and get $1.25 billion is...
Oh, it's crazy. Well,
they were unusually slow. Unusual in how slow and methodical they were, according to this. They were very organized in comparison to other groups, which are kind of more of, I guess, a smash and grab technique. Or an isolated type of an incident where they were very, very methodical in how they were able to acquire the money and then transfer that into Bitcoin or cryptocurrencies. But then, you know what? They made a mistake. And
don't they always? He just always.
Yeah.
Happens,
So apparently going out and buying vast estates on the Mediterranean with cryptocurrency is going to get you noticed, folks.
So don't do that. Don't do that. Yeah.
Bring a little bit of attention to you.
Well, I think, we have a client who knows a lot about this background in the cryptocurrency, and he was saying that the majority of cryptocurrency exchanges or the management of the funds through there is some sort of criminal background. Like the majority of it. I don't know if that's 51% or if that's 90%, but he said that's a report. I don't know how he is a valid source, but I don't know how extensive that is. But that's a little scary. I mean, these guys are super smart, and they.
And interesting too, 100 financial institutions. So they figured out somehow to make a pattern that worked, and they continued that pattern up through 100 companies. But eventually, you end up getting caught. That's for sure.
Do you remember that story years ago about the guy who was collecting a half a penny from every transaction or something like that, and it was rounding a penny into his account and a penny back into the other person's account. So no one saw it, but
just
the money was...
Yeah, because if you have a penny missing from your bank account, okay, big deal, but...
No, but it wasn't, because he was buying half a penny, so it would round the half a penny back up to a whole penny on both sides.
Some guys have too much brains, man.
I was like...
Of course, it's interesting because they're so smart, but so dumb in a way because these guys are probably paying for it forever in jail and that kind of thing.
Well, I mean,
the penalties they pay.
If you stole $1.24 billion, you'd think you'd be able to, get some sort of super accountant person to handle the other side of this. I mean, this is just plain old dumb.
They need a lifestyle coach, is what they needed.
Don't go buy the most expensive house on the block.
Our show today is about evaluating investments, so we're going to get to that in just a minute. But our next article on Money in the News is really about an investment that very few people out there can afford, and that is a private jet. Now, I know, Seth, you probably have a couple, and it's hard to keep track of the maintenance and all on those.
Yeah, which one today? That's really my biggest question.
That's right. But there's a reason why people don't buy these. One is they're so expensive to buy, but not only that, is if you're buying one of these things, you got to pay to keep this thing fueled up and to have the maintenance done on them. They're just incredibly expensive to maintain. But you guys remember that show years ago, Lifestyles of the Rich and Famous, with Robin Leach, right? Was that his name?
Yes.
I think so. Yeah. Wow, man,
I don't know why that came to me right now, but I remember watching that show. I was like, wow, this and that. And it's really kind of a fascinating thing.
That is an 80s icon.
Lifestyles of the Rich and Famous with
John,
Robin
you are
Leach.
Definitely much older than both of us.
I am definitely. These guys remember shows from reality TV like American Idol. That's what these guys remember.
I was just a little kid.
Yes, I remember. Yeah, Mr. Rogers' Neighborhood and Lifestyles of the Rich and Famous. No, but so here's why the ultra rich splash out on private travel. According to the new research out there, the cost of owning and maintaining a private jet is so great that the estimated mean average wealth of such a person is calculated at around $1.5 billion. Much less than that, and the numbers simply don't stack up. So if you wanted to buy a long-range Falcon 2000 DX, it's estimated to cost around $40 million. And that's only the upfront purchase price. This has led to the rise of alternative models, such as that fractional
jets. Is that on the used plane lot?
I don't think so. I think that one was a new one. I have actually a buddy of mine that sells these things. It's funny because years and years and years ago, he'd be happy just to be able to sell one jet a year. But it's amazing over time he's really built up. But he's just networks with these CEOs of different companies, and over time he's actually figured out how to make a very, very good living out of it. He was working for someone, but now he's working for himself. But there's so many companies out there that actually use these private jets. Sometimes universities use these private jets. In fact, I know he got a lot of his sales from working with several local universities. But these guys, these guys that are ultra rich, really don't want to sit around waiting. And we have all felt that, ultra rich or not, when you're waiting for a flight and you get delayed or whatever. But I know you've had some fun travel recently with you're waiting for a jet to come in. You couldn't go out because of a snowstorm, and it's always a big pain. And you always just wish that I had my pilot bring the plane around, but I didn't remember that. Yeah, so that's
invariably it seems like there's always like something going on at an airport. That's but you think about it. These people are literally, taking up in the air hundreds of people and dropping them off somewhere else in the world, and we're like, oh, you're going to delay me for 30 minutes? It's like they are bussing people around through the sky. It's amazing.
Yeah. Now, some of these guys that are ultra rich, they don't want to be flying on public flights. They might be, they might not want to have it around that they're actually going to certain meetings and all. So they'll have their meetings up in the air, and it's kind of a very exclusive club. But I guess one of the things that they really like about it is just the convenience and the fact that they can do their meetings, they can do whatever they want while they're up in the plane, and they don't have to worry about.
The meeting runs late. They're 2 hours delayed. They don't want to have to wait around for the next flight to be able to get them where they need to go.
Yeah.
And actually, Damian Lillard, Trailblazer, right now he's going to be playing. Not Charlotte, but the Pelicans, New Orleans. But he's expecting a baby, and so guess what? He's got a private jet waiting for the call to get back to the hospital, honey, because it's happening.
Must be
now.
nice, Seth. Must be nice. Yeah.
I'm glad. I'm like,
for
that's
them.
amazing, because that would be a really hard part of being in that kind of a position where it's like, oh my gosh, it's playoffs. Like that's where we're at, the playoff corridor, right? Wrapping up a season, every game counts. You're the star player on a team, and people may not understand you not, stepping out of your firstborn's birth to not play tonight or something like that. So boo on us, I guess, for not understanding why they want to have a life on top of their careers as well.
When I was reading this article, I found it really interesting that there was a perspective of that people sometimes don't want to use their own jet, like they want to share in jets because it's less
ostentatious. And
it was like they didn't want people knowing where they were going if they're landing in a certain city or country or whatever, and they're in a certain business, they would, their competitors would know.
So a fractional jet means that they don't.
Yeah, I thought that was interesting.
Not known as well. Yeah,
there's a little bit of
anonymity is a big deal, isn't it, in these circles? Yeah.
So coming back into this, like that sports arena, I think that's interesting when the hiring and firing of coaches goes on. There's all the hubbub of who could possibly
who's coming in. Yeah.
Well, they start tracking jets. That's one of the ways that they start finding out who's in town, right? Because so-and-so's jet has now landed.
Well, it's interesting. Speaking about investments, when we were meeting with that.
Oh yeah, I know what you're going to say.
Yeah. Well, go ahead.
No, so this guy was just kind of telling us about some investment opportunities that were in Texas, and he was saying how a lot of people are moving from California to Texas just because people are getting tired of the regulations and the taxes and all that in California, so they're moving to Texas. And I was telling this guy that was talking about his investment, saying, I have a cousin who did the same thing. He was tired of paying all the taxes and just decided to move to a much easier life in Texas, and he's doing very, very well as a result. He said, that kind of relates to the U-Haul index. And both Ben and I kind of like, what do you mean the U-Haul index? Well, there is actually an index out there that
is tracking
movers. It's tracking. So if you're picking up a truck in New Hampshire and you're going to Oregon, there's this, and so you have this
that doesn't happen actually.
It never happens.
There's no index for that one.
Thank you, Lord, that never happens.
but so with the U-Haul, with the U-Haul index, you can actually go online, and actually did. You can actually see the percentage of where people are going and where people are coming. And the president of U-Haul basically said, hey, when people come to U-Haul, they're making some. Usually there's a reason. There's a very, very big reason. They're deciding to sell their house for $350,000 here and go over to buy a house over here for $250,000. There's a job, there's a marriage, there's maybe a job loss, just all these different things that are.
Yeah, we were talking about it. And they were saying how like when BMW moved and the different car manufacturers moved, they could see the index jump from where the plants were previously to where they were moving to.
Yeah, you think about that. We were talking about how some of these areas are so crazy big. South Carolina has been growing a lot. Atlanta's been growing a lot. And so they're seeing the U-Haul index is showing a large percentage of the country moving to these different hubs. Texas is another one of them. Yeah. So, and there's some places they're moving out of too. So,
yeah. Hey, something
is that Oregon?
I spotted. Oh, you guys. So something I don't know if you spotted this, but kind of bringing it back to last week, we talked about Toys R Us and the decline of Toys R Us, the bankruptcy there. Guess who is starting to consider picking up the pieces of that brick and mortar operation? Amazon.
I cannot guess. Oh, well, what do you know?
What do you know? Right? Right. I mean, there's already an established supply chain, and all the logistics are there now. Thank goodness that Amazon isn't looking at Toys R Us website thinking that there's anything there that they
anything of value. Yeah.
I did that one time. That was the last time I ever used their website. It was so frustrating. Have you guys ever tried to shop Toys R Us online?
It is interesting.
I don't like toys.
I actually didn't see that, but that's great. I mean, honestly, that's a really I mean, we're just watching Amazon's buying up industrial buildings everywhere.
Yes.
And so for them to buy up a, kind of a front store space.
A lot of different locales. I think they have 800 locations. I mean, that could be interesting.
Could be the kind of like a pick up at the store kind of place.
Yeah.
Save $1 or two.
Maybe your local drones leave from the local Toys R Us and deliver it to your backyard. I don't know.
Yeah.
Doorstep.
Clearly, we need a whole show dedicated to Toys R Us, and we will consider that at some point. But right now, we're going to take a break, and we'll be right back. You're listening to Money on Tap.
On this Cliff Notes edition of Money on Tap, John, Seth, and Ben take a sobering look at the future of our Social Security benefits.
Listen to this. In 1940, the year that first Social Security monthly benefit check was written, a 65-year-old male had a life expectancy of 12.7 years. A female of the same age could expect to live until 79.7, an additional 14.7 years. According to a 2009 periodic life table for the Social Security population, the life expectancy of a 65-year-old male has risen to 17.5 years, almost 5 years longer than in 1940. The life expectancy of a female at age 65 is now 20 years, an increase of 5.5 years. So we have people that are living longer and longer because of advances in medication, perhaps healthy lifestyles, that type of thing. And that is causing people to be taking more out of the system than they ever imagined would happen. And they haven't really changed those numbers. And so that's one of the major issues.
What we have is the population's moving behind the Gen Xers and the baby boomers, the millennials, who define approximately 21 to age 37. So they surpass the baby boomers of a population of 74.9 million. So they've just recently surpassed at 75.4 million. So that's not a huge number moving past them, but they have surpassed that number. Now, it's an increasing number with immigration. So what the projection is here is at 2036, that's basically when they're saying they're going to run out of money.
Reduction of benefits,
so at 2036, they're scheduled to be at about 81.1 million. And at that point, the oldest millennial is going to be around 56. So prime earning years, larger population, why doesn't that balance the scale?
All these estimates about when Social Security is going to run out of money is taking into account the foreshadowing of what population growth is going to be. Now, if we are missing a certain amount of people coming into the country or a number of different variables that could be skewing the number, we're still on a downward spiral. I mean, we're basically less than 20 years away from Social Security running out of money. And in the next 20 years, we have like 80, 90 million people going to retire to collect Social Security. We be more than are retired now, I think. I mean, the factors are in there to evaluate that it's failed.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Seth, Ben, and John.
Welcome back. You're listening to Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Today, we are talking about how to evaluate an investment. So here's some tips for you on taking a look at what you might own right now and why, and what's important to consider when you're evaluating a portfolio and of investments. So with that, why don't you take it away?
I'm going to jump in here because we get calls all the time, and we just had a referral this last week. Someone wants to come in and say, hey, I want a second opinion. And usually that means I want you to look at everything. I want you to evaluate whether or not I'm going to accomplish my goals. Here's my goals. And we'll have, what, John? Couple hour session.
Oh, sure.
At least sure. Just trying to go through it and understand what they own. And we'll ask them invariably, John, what?
Why do you own what you own?
Why do you own what you own? But that's the thing. People sometimes do know and sometimes they don't, but most of the time they don't, John. right? I mean,
Well, that is the case. So many times we see people that have just a we call it a shopping bag list of a shopping bag full of different things, of different investments that they have, and they know I bought this one back in '80. I don't know. Sometime I have a statement on it, and they just don't really have a clear understanding of why they have what they have, and that's really what we spend some time talking about. Hey, why do you have what you have? Is it taking care of? Is it meeting its objectives? And many times the people haven't even thought about objectives on the dollars.
When I jump into things, I usually am asking them a little bit about, where they're at, what their future holds, what they want their future to look like, and that's usually a long part of the conversation before we even start saying, "Oh, well, you own this and you shouldn't." That's usually I see that with other advisors, and I'm like, sometimes what people own really is good. Like, I've had people come in and be like, I had a gentleman come up to me one time. He's like, "Yeah, I was gonna chat with you, but I family member talked to me, and I just wanted to do business with him and so forth." I said, "Oh, great." He goes, "So what do you think about XYZ product?" I said, "Wow, well, considering what I know about you, it's a good company. I mean, it's solid offering. So yeah, it was probably something that may, if he thought it was relevant for you and you felt like it was, it's not a sham, that kind of thing. But there's that need to really evaluate, all the pieces around it. And I think that's what we're going to go through today is the four pieces.
There's a lot of questions that you can ask, but there's four that we're really going to focus on today. And the first thing that we really want to focus on is liquidity, meaning that, if you put your money into something, you really want to ask some questions about the liquidity aspect. Well, think about it very simply, guys. If you go to the bank and you put your money into a checking account, you understand that this is very liquid, don't you? You know that, hey, I put the money in there, I put my $5,000 in there, and if I want to write a check on it the next day for that $5,000, I can easily write a check for $5,000, not for $5,001, but for $5,000. If I put $5,000 in there, I know that I can go purchase something with that. And that's everyone understands that when it comes to liquidity in a checking account. However, some people will say, you know what, I really want my money to do a little bit more than it will do in a checking account. And I want to put my money into a CD. Well, now you have another layer, don't you? Because that CD could be a 6-month CD. It could be a year CD, or maybe even a 3-year or a 5-year CD. Sometimes we see those out there. Obviously, the longer you leave the money there, the better you can do. But you do have an understanding that when I put my money into a CD, that there's going to be some penalties. So that is really not as liquid as that checking account would be. And the same holds true when it comes to investments. When we put our money into investments, well, there can be some investments out there that we can have immediate liquidity, meaning that we can get at the money right away when we need it. But there's also different types of investments out there that when we want to pull money from them, there can be penalties for doing that.
Yeah, I mean, that list goes all the way up to you can't pull the money out at all.
Ever.
Yeah, the list is almost endless. And I think, John, I would even say it gets even more granular. Like if you just break down the difference between checking, savings, and CD, it's like, well, a checking is immediately liquid.
Yeah.
Savings account, you either got to go to the bank and move the money to the checking, or ask the bank to write a check. So that's another degree of a little less, another hoop. And then CD, some sort of time commitment. And then, like you said, 6 months. It could be a year. It could be 5 years. I think when you look at that, people usually think as liquidity as either it's like an on or off switch.
Yeah.
Like it's either liquid or it's not liquid. And in reality, it's more like a temperature gauge, kind of like climbing the ladder of temperature. You go from 0 to 400 degrees on the stove. It's like, you're either fully liquid or you're some degree of illiquid.
Ben, that's a great point. In fact, Seth, one of the
Wait, can you repeat that last part?
Ben, that's a great point.
Okay.
Ben's going to rewind that several times, yes. But Seth, oftentimes we've talked with our clients about certain type of investments that have liquidity, but sometimes there's some limited liquidity. So, for instance, you could put your money into an investment that you might have 10% of that contract that you can get at every year. If you do more than that, then they hit you with a penalty. But if you do less than that, you're totally good. So you have some liquidity, but not total liquidity.
One of the things that around liquidity sometimes that comes up is where is that money? Where's the purpose of that money? Where is it being held? For instance, the qualified versus non-qualified. Those are usually two of the kind of ways that we compartmentalize.
Like IRA, non-IRA, yeah.
Right, the checking account, the savings account, those are typically going to be the non-qualified kind of investments. But those IRA and qualified 401k investments, they already have an almost invariably an automatic 59 and a half timeline, like
Right.
age 59 and a half, just pretty much don't even want to look at those or consider those for, any kind of liquidity factor. So, structuring around that sometimes when we're starting to, build in illiquidity for reasons of, to certain strategies for diversification, timeline diversification, asset diversification classes, all these kind of diversification pieces that we can put into, building the portfolio. People might have a question of or a concern around the illiquidity. Well, one of the hurdles that we can kind of get out of the way there is, well, are you going to use that money before 59 and a half? No. Well, then don't worry about it. Right. I'm not going to worry about it. I mean, if you get into a place where you really need that money, that illiquidity factor is probably the last concern that you have at that point in time, and in portion or in part, yeah.
And that's where, I mean, Seth, when you speak like that, and I'm kind of walking through this because as probably a listener is looking at this, is like, well, it's I guess it's not liquid because it's my retirement plan, but well, it is liquid with a cost, right? There's a if you're under 59 and a half, you have a penalty,
10% premature penalty.
You're going to pay taxes on that. So, depending on what tax bracket, you might only be getting 70% of your money, or you might be only getting 50% of your real asset value there. And I would just say that's a cost to liquidity, right? So, at some point in time, depending on the person's assets and so forth, there's a cost to liquidity. It was kind of a part of a conversation I had with somebody the other day who was, unfortunately, going through a divorce, and we just chatted about, trying to get financially stable again and all of those pieces. And that's a reality for anyone who has to go through that tragedy. But sometimes there's a cost to just getting things correct, getting back to square one and so forth. So, sometimes there's that cost of liquidity. And I think, when we think about the temperature gauge on liquidity, and when you go from 0 degrees and it's a checking account, and you go, up to, stocks, bonds, and, mutual funds or whatever the investment is, well, there could be a cost to that liquidity too. It might be liquid today at this value, but if you need the money 3 weeks from now, it's liquid at a different value.
Yeah, it could be down. Yeah, when you need it.
And then you have other investments who are completely illiquid. And, we get into things like accredited investors, and we start talking about, how much is someone's net worth. So an accredited investor is somebody who's, worth over $1 million outside their home.
Yeah.
Has, anywhere between a $200,000 to $300,000 income, whether they're single or jointly married. And,
for several years in a row, too. They have to have that, yeah.
There's all these different things. And that ultimately is to protect somebody who may, because there's kind of this understood or perceived understanding in our industry that, if you're worth a certain amount of money, that, you have a presumed investment sophistication.
Right.
And so if you're worth over $1 million outside your house, that means you can really, you're hey, carte blanche, go take all the risk you want. You understand what
and that may not be the truth. But
it really isn't, but
just because you make a lot of money or you saved a lot of money doesn't mean necessarily that you have an understanding of these things. But
it's not like, if you made a lot of money in the stock market, maybe you do deserve that. But
right.
Some people, work their whole lives to make that money and so forth. But even with that really red hot temperature, you can be completely illiquid. And I've run into people who are like, "Whoa, this thing is XYZ," and I haven't seen value from it and so forth. I remember one woman came to me, and I was like, there is no liquidity to this. Like this is
it's a hard conversation sometimes when people don't understand that.
It's really a weird conversation. It's not our fault, but it's so it's really important to understand that liquidity. And I really feel bad when people don't understand their investments as well as they should before getting into that kind of stuff.
Yeah. I wanted to ask, and I'll just throw this out to you guys. So we have liquid investments and we have illiquid investments. And to be honest with you, when I think about the two, I think, well, why would I ever want an illiquid investment? I want to be able to have access to my money all the time. But there are some reasons why that we consider illiquid investments. And I thought maybe we could talk a little bit about why we would even consider an illiquid investment for someone or for our own portfolios. Well, there's reasons for that. Let's talk about those just a little bit, about why we would actually consider an illiquid investment.
Well, at the moment, I'm having the hardest time coming up with an answer to that, because the two examples I could think of this last week were a 40-year-old couple that basically wanted liquidity within a year. right?
Okay.
It was kind of the vacation money scenario, and it was where do we put this to earn more than the 1 year CD, right? But that was money that they wanted to have access to and liquidity. The other example that I had was the 87-year-old woman that sat here with me for 2 hours, and the investments that we're discussing, she doesn't even need them, and they're qualified money. So they're she's clearly after the 59.5 time horizon that we might discuss initially. She has no need for this money, but there would never be I'm trying to imagine, why would there be an illiquid kind of an investment that we would lock up that money when she does that just doesn't make sense. So kind of making sense of the scenario, first of all, would be one of the first things that we want to do, and in both of those were both illiquid scenarios, and so the opposite of that would be really, I think, where the person is in a place where they have an expectation or a goal, or the objective that they need to meet might have a time horizon of, say, 5 to 10 years. That might be one of the considerations that we have.
Yeah, so you're saying that manager really has a strategy in place that it's not a short term. He's not looking and saying, hey, well, in 6 months, let's reevaluate. He's saying, hey, no, we're going to this investment with the expectation that it could be 5, 10, it could be 12, 13 years until we actually see what we want to see happen with this investment. And this is a long-term commitment.
Or the other side of that, I would say, too, is in the scenario that I just laid out, where the lady's a little older.
Yeah.
But she might have a real income kind of a concern. And some of the illiquid investments can be quite good at creating an alternative source of income that, once turned on, really accomplishes that goal. And that would be another factor there.
So an annuity or a bond or something like that, if you wanted to hold it for a long period of time, and ultimately collect income from something like that. Yeah, I could see that as being like number 1 or A on that. Something that comes to my mind on this area is when people own the illiquid investment, whether it's just the idea of, this might simplify it, putting money into your 401k or your retirement plan. Yep. It's kind of like set it and forget it. Like, I don't want to think about it. I'm not going to make rash decisions. I'm not going to bounce out of the market. That would be kind of like a number 2 for me, Seth. In just that being a perspective of, if I buy something that's illiquid, I won't be forced to just jump the gun on an emotional whim, because I find that people managing their own money are the worst investors, because everything's
that's the case.
Yeah, everything's emotional. Another area where illiquidity can provide opportunity is in the diversification of assets. I mean, where you can get into classifications, like a lot of people buy we have a lot of people up here that own duplexes and multifamily homes that they've owned, or an office building or whatever. That's an illiquid investment. I mean, people don't look at it that way. They just look like, well, I have that asset.
And it can provide some nice income for them along the way, though, can it? Which can be a very valuable thing for folks.
Yeah, but then you can take that degree right into the investment world, and you can buy real estate programs that are completely illiquid, where you say, hey, I don't have the ability to really manage my own office building or whatever, but I do want that exposure to that risk class for diversification reasons. Well, do you want, how liquid or illiquid are you willing to go depending on the opportunity?
Yeah, so they're really very similar things. I mean, you can buy a security that is invested in real estate that does not give you much liquidity, but then you can also go out and buy your multifamily. And you know what? I've known people around this area, New Hampshire area, that have had a multifamily for years and they have not seen appreciation from it. They've seen actually a decline in that. And for them to actually get out of that is hard, so they hold on to it for a long time. But the people that I've talked to that are real estate investors in this town, they're looking at holding on to their real estate for 20 or 30 years. That's what they want to do when it comes to that.
And they're looking at, when you say I'm going to hold it for 30 years, that's not liquid.
No.
That's not.
It might not be the right type of investment for you either. If you have to be into an investment that's a 15 or 20-year investment, that may not be a suitable investment for you.
Yeah, correct. Mm-hmm. Correct.
Just depends.
Well, number 2, as we kind of move down the ladder here out of our 4, number 2 is risk versus reward. I think that's something, John, I'm going to ask you to jump in on. I think reducing your investment risk through diversification. Let's talk a little bit about that.
So risk versus reward. Oftentimes, when I'm thinking about things as far as in relation to reward, I often think about that checking account. When you put money into that checking account, there's really not much of a chance for reward in there. But you know what? There's not a whole lot of risk in there. Although if you think about it, if you do have a checking account for a long period of time, we have something that's called inflation risk, meaning that your assets are not really gaining anything in value at all. So as the cost of everything around you goes up, you're still sitting in that checking account. So there's some risk there. But basically, I look at the checking account as a very low type of risk thing, and your reward is very low. Now, there are also types of investments you can go into. You could talk, this could be a stock that you go into. That stock could certainly have some risk. You can go into some companies that are not very risky at all, but then you can go into other ones that are quite risky. Many times we look at large blue chip companies as not having as much risk as perhaps a new company that's starting out in a new industry. There's many types of investment companies that you can go into, that you can invest into, that have a very high risk level. And you look at even maybe the last couple of years, and they've had significant decrease in their share value because of the type of risk that they're involved in. So whenever you go into an investment, you really want to have a clear idea of, well, what's the risk-reward ratio? What kind of risk am I taking? What kind of reward can I expect? Knowing fully well that when you go into an investment that has some risks there, that you could lose some or even all of your money
right.
when you're doing that.
I think as we talk about the temperature gauge, risk is very much a temperature gauge as well. You go from 0 to red hot, 400, 500 degrees as well on the risk scale. You can do that. And I think if you look at those two temperature gauges together, what the perspective of how you measure risk, and we talk about three-dimensional investing, this is where it gets complex, right? You've got two different planes of temperatures rising, and it's kind of like, do I let it simmer or do I do a quick searing on the grill,
Sure.
and so there's a little bit of back and forth inside. Seth can probably appreciate that analogy better than most, but
I'm getting hungry.
But I think when people look at diversification through risk too, right? They're gonna start buying in, and this is where illiquidity and liquidity cross that risk plane. Is you got two temperature gauges going on, and they're not parallel to each other. They're running congruent to each other.
Seth, tell the listeners about the program that we use that helps kind of identify risk, because a lot of people kind of don't know what kind of risk level they should assume or what they're comfortable with. But share with the listeners what we use.
I feel like I'm about to brick a layup, John.
Here you go. This is a layup. This is a layup for you, buddy.
The answer you're looking for. So I think what you're kind of talking about is our risk assessment tool that we use on
Absolutely,
our website.
yes.
That anybody can go onto our website at brayshawfinancial.com.
2-0. That's the game we're playing. The layup was made. All right, good.
Yeah, so it's available to anybody that wants to go onto the website and go ahead and take a look at their portfolio, assess their risk. Basically you can slide your portfolio into this, take a look and see where the risk numbers kind of line up and see where you are as your own personal risk profile and see how those things line up. And it gets some of the strategies that we build actually are sometimes a little hard to articulate in that definition of a risk number, because we can have some strategies that are down the road that might have a little bit more of an elevated risk associated to them, but the timeline is out there far enough that it doesn't really quantify it that way. Here's
what I love about that program. I love it because it basically has on the system different speed limit signs. So it has like a speed limit 1 all the way through speed limit 100. Now I know I'm certainly under the 65 limit most of the time when it comes to driving on the road.
Liar.
Most of the time. But the fact is, it helps you get a very clear picture of what type of risk level you have on your current portfolio, and also what you want to have happen when it comes to your portfolio going forward, as far as what kind of a risk you want to assume. So I think that's an extremely valuable tool that listeners can assess what their personal risk level is.
Here's one of the other things too that we have as far as like what is the expectation off of those. Like when you're talking about a higher risk level, typically you would say over time there would be a higher return. It's interesting to be able to take a look at an analysis and say, hey, we can have a much more moderate risk, or take that approach and really be able to expect a far greater return over time with taking less risk on. And that's one of the things that I think that really helps us to understand. Hey, we're going to take a quick break here at Money on Tap. We'll be right back.
Hi, my name is Seth Krussman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Now back to Money on Tap with Ben Brayshaw, John Ryder, and Seth Krussman.
Welcome back. You're listening to Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Hey, we have been taking a look at investments and how to consider different investments. What is kind of the hit list here that we go through in understanding how to place an investment? There's liquidity is a factor. There's the risk reward that we just talked about, but there's also, hey, the objective of this investment. What do you guys say about that?
Well, hey, you were talking about a client that you were talking to that had an objective for a 1-year goal. All I know is that if I'm investing money for a client for a 1-year goal, the recommendation that I give to them is going to be a whole lot different than someone that I'm talking to that has a retirement 10 or 12 years out. But you know, a lot of times what people try to do, they try to say, well, you know what? If it did 10% last year or 12% last year, well, I can probably expect to see that again. And that is just not the case many times. So we want to be very, very careful. We want to take a look at what the objective is. What is the time frame of that goal? And if it's a long-term time frame, then we'd certainly have some different recommendations than a short-term time frame.
One thing I'm exhausted in our industry about is the investor amnesia.
Forgetting what happened in the past, for sure.
I had somebody the other day say to me, well, my 401k did, whatever percentage points and blah, blah, and I don't even know what their 401k is invested in. And I'm looking at historicals compared. I'm like, you know what the S&P's averaged over the last 15 years? I mean, so you think you can do that every year? I mean, they're convinced. I mean, it's amazing at the sales job.
They do to themselves.
They do to themselves, yeah. So I think an objective is obviously huge. And that's where, we run quickly into the time horizon, but I don't want to jump too fast. But if you don't know what your objective is with those dollars, then you can't break out the different degrees of investment. We talk about laddering, it's a very common term in our industry,
sure.
Laddering investments. What people mean by that is like, and the most common places that's used is in bonds, where they ladder bonds because bonds come due at certain time periods.
Like
so
every 6 months or 6 or 8
year
or
whatever. Yeah. So you might say, I want a 5-year ladder or a 10-year ladder. And you say, I want them to liquidate, I want 10% to liquidate every year for the next 10 years. So, 100% of my money will be fully liquid in year 10. And, people don't realize that, sometimes what we do all the time is we are laddering different types of investments all over the place, from fully liquid to illiquid, across the board.
And it may be laddering maturities. So, hey, here's your go-to bucket. You get the money from right away. Here's money that might be locked up for 2 or 3 years. Here's 5 or 6, 7 or 8.
But they all have a plan behind them. I think when we talk about the temperature gauge and we talk about going to full illiquidity, you shouldn't be looking at something. This is straight out. This is 100% believe this. You should not be looking at a fully illiquid investment unless you're working with a financial planner.
Risks are too great.
Yeah, risks are way too great. The potential that you're going to understand all the details around that investment and so forth. If you're going something greater than a 10-year illiquidity time period, you're probably walking into something that has way more obligations than you're able to understand, even on a first visit or second visit. You want to make sure that a financial planner is working behind the scenes on something like that.
Ben, we're going to spend some time talking about that next time. We're kind of getting ready for the end of our show here. We're wrapping things up. In fact, we wanted to get to the 5 buyer bewares for investors, but guess what? We are running out of time. We're going to talk about that next time and talk a little bit about things that you should really be careful of when it comes to investing, because there's a lot of different people out there pitching you different investments. You can turn on late night TV and you see the infomercials going on. There's certainly things that you really, really want to avoid. But I can tell you that there are certainly things that you should be looking at and certain things you should be avoiding. I know one thing we want to hit before we close here
is our fourth and final.
Yes, our fourth and final, the time horizon. And let's go into that a little bit, Ben.
Well, we were just chatting a little bit about it as with the investment objective of how, what do you want to accomplish with those dollars? And then you want to say, all right, well, how much time do I have between now and then to accomplish it and so forth. So there's a balance inside that. I think, John, one of the things that happened for us, as we evaluate financial investments all the time, we have these people come into our office, talk about XYZ, and the first thing we ask is, what's the commitment here? What's the time horizon of this investment?
Sure.
And we look forward on that, but we also spin the ball backwards and we say, how long have your other investments lasted? How much success have you had with those types of things?
Yeah, so company ABC, you're talking about this specific offering, but how has the investment that company started back in 2011 done? And how did it do? Did it return the principal to the shareholders? Did it pay a decent dividend rate?
Yeah, what was the outcome? I mean, in looking back on those types of things, there's all sorts of funds, there's all sorts of things, there's closed-end, open-end. I mean, you can get into detail, into the weeds inside all of this stuff. But your time horizon, is where you drive the value you equate to what you're going to receive from the risk you're going to take, the illiquidity you're going to agree to, and the objective that you're trying to accomplish. And I think when you start bringing all of those pieces together and you start bringing the three-dimensional side of that together, that happens with planning.
There are some investments that we would certainly not recommend to someone that's just retiring. It just would not be suitable at all for them. However, if we're talking 10 years earlier, well, that may be certainly a great place to talk about that investment. But there's the time horizon really dictates which direction we'll go oftentimes when it comes to investing people's money.
Yeah, I was just going to add that sometimes we refer to some of the ratings companies out there, AM Best, Moody's, SP, complaints. Have there been any complaints about the company? Better Business Bureau, state insurance commissions. These are some of the places that we're going to go to do the research and due diligence, really on the behalf of you, our clients. And it's our job to screen through these investment offerings and find the investment that's not only a good quality investment, but an investment that will be great, a great fit for whoever it is that we're working for, you, our client. And we want our clients to have a successful experience when it comes to their investments. We love working with our clients. We want them to really love working with us and to have a good grasp of what they're investing alongside of us, what they're investing in with us. And a basic understanding, a general understanding of what it is that they own, while not, understanding every aspect or facet of the investment. It's really important to know why they own what they own, and it's for this reason that we like to see our clients on a regular basis and make sure that they have a clear understanding of what they own and why. That's going to do it for us here at Money on Tap. We've had a great time today, kind of uncovering 4 basic things to understand, I think, when taking a look at your investments: the liquidity, the risk reward, the objective, the historical or the time expectations, time horizon of those investments. And you can reach us at 855-226-8551 and info@yourmoneyontap.com. Thanks a lot, guys.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.